In the previous class, we were discussing about technical analysis. Now, as part of technical analysis, certain mathematical indicators and market indicators are also considered before making a buying or selling decision. That is, apart from charts which are drawn using closing price, opening price, or highest price or lowest price, will also depend upon the mathematical indicators and market indicators before arriving at a buy or sell decision. So let's see in detail what are these mathematical indicators. See, we know that the price keeps fluctuating on a daily basis, the price of shares in the market, shares or securities. So you're going to get confused about when you're trying to find out the trend. So what mathematical indicators do is that they will find an average of the fluctuations in order to understand the underlying trend, whether it is showing a rising trend or a falling trend. So the first method under mathematical indicators is moving averages. Under moving averages, there's simple moving average and exponential moving average. The second mathematical indicator is oscillators. There will be a central point and then we'll decide based upon the fluctuations from this central point whether to buy or to sell the securities. Some popular examples of oscillators are ROC, which stands for rate of change indicator, RSI, which stands for relative strength index, and MACD, which stands for moving average convergence and divergence. So let's see each of these in details. The first one under moving average is simple moving average. So I've given a table. This table has been taken from S. Kevin's textbook. So we can check this table to understand moving average better. See, the 15 days closing prices has been taken. In order to calculate simple moving average, we depend on closing price of the securities. Closing price is nothing but the price at the end of the day or price at the time of closing of trading of a particular day. So the closing prices has been taken for 15 days of a particular security. Now we are going to find out the 5 days simple moving average. In order to do that, we are going to add the prices of the first 5 days together and show it in the third column. That is 33 plus 35 plus 37.5 plus 36 plus 39 will give you 180.5, which is shown in the third column. Because it is a 5-day simple moving average, we took the first 5 days prices and showed it in the fifth column. If it was a 4-day simple moving average, we would have calculated 4 days closing prices total and shown in the fourth row. Okay, we would have shown it in the fourth row, but because it's a 5-day symbol, we are showing it in the fifth row. So 180.5. Now we have to calculate the average. That is 180.5 divided by 5 will give you 36.1. So that is the moving average for the first time, fifth day. Now if you want to find out the 5-day simple moving average of the next day, then we are going to eliminate the first price and add a new price. That is 35 plus 37.5 plus 36 plus 39 plus 40 will give you 187.5 as shown in the third column. That divided by 5 will give you 37.5 as shown in the fourth column. Now again, to find the next day's price, we are going to leave out the second day's price and add the 7th day's price. That is 37.5 plus 36 plus 39 plus 40 plus 40.5 will give you 193. That divided by 5 will give you 38.6. So we leave out an old price and add a new price, and in such a way we'll keep on calculating the simple moving average. So under moving averages, the first one was simple moving average. I hope you understood how it is calculated. The second one is exponential moving average. Now, in order to calculate the EMA, there is a formula. The formula is current closing price minus previous EMA into factor plus previous EMA. Okay, so In order to calculate the factor, the common formula for a particular set of EMA is 2 by n plus 1. So see the question, for the 10 days closing prices are taken into consideration. Whenever we are calculating the moving average, we'll consider the closing price. So 10 days closing price has been recorded, and then we are going to calculate the EMA. The first day's EMA is calculated using the formula. That is the current closing price is 33 minus the previous EMA. There is no previous EMA. So we know now that the 5-day moving average, in case of exponential moving average, we are going to calculate from the second day onwards. For the first day, the closing price itself will be considered as the EMA because we cannot apply the formula since there is no previous EMA. So for the second day, the current price is 35 minus previous EMA, which is 33. The previous EMA is same as the closing price. So 35 minus 33 into factor. We need to calculate the factor, and the formula is 2 by n plus 1. Since this is a 5-day EMA, we are going to take n as the 5. If it was 6 days, we have taken n as 6 and so on. So factor in this case is 2 by 5 plus 1. That is 2 divided by 6. That is 0.33 is the factor. So the current price 35 minus the previous EMA 33 into 0.33 plus the previous EMA, which is 33. And you will get the EMA for the second day as 33.66. Now, in order to calculate the EMA of the next day, the third day, the current price is 37.5 minus previous EMA, which is 33.66 into factor, which is 0.33 plus the previous EMA, which is 33.66, will give you 34.93 and so on. And such a way we are going to keep on calculating. If we are calculating the 5-day exponential moving average, the correct EMA will be available from the 6th day onwards. Okay. So we know to calculate the simple moving average and we know to calculate the exponential moving average. Now, after making out these calculations, we are going to plot these in a chart. Okay, so to find out the trend or the underlying trend of the market, if you're calculating the average for a 5-day period, then you can get the short-term trend. For 5 to 10 days, you can calculate the short-term trend. If you're going to calculate for 50 days or above, then you will get the medium-term trend in the market. And if you're going to calculate for 200 days average, then you will be able to find out the long-term trend in the market. Now, once all these averages are plotted in the price chart, we are going to connect these prices together with a curved line. And then we'll determine the trend line. Once we draw the trend line, we'll be able to understand whether it's an upward trend or a downward trend. And we'll also be able to study the first signs of trend reversal. Suppose it's an upward moving trend. Slowly it's turning downwards, then we know there's going to be a trend reversal and prices are going to fall, and we can take decisions as to buy or sell accordingly. Sometimes the two moving averages are both recorded in the same chart, and then we'll study the trend. So that is with regard to moving averages. The second one of the mathematical indicators is oscillators, and the first example of oscillator is rate of change oscillator, also known as ROC. While calculating ROC also, we'll take into consideration the closing prices. So the formula to calculate rate of change oscillator is current price by price n period ago minus 1. Suppose we are calculating a 7-day ROC, we are going to start calculating from the 8th day onwards. So since it's a 7-day, the price n period ago means the price 7 days ago. So here on the 8th day, the current price is 75 divided by price 7 days ago is the price on the first day, that is 70. So 75 divided by 70 will give you 1.01. Minus 1 will give you 0.07. On the 9th day, that is the current price is 78 minus the price 7 days ago will give you the second day's price, that is 72. So 78 divided by 72 will give you 1.08 minus 1 will give you 0.08. Likewise, we are going to calculate the ROC of all the prices. And then we are going to chart these out in a chart. We are going to plot it out in a chart. Closing prices are considered for calculation of the moving averages and also the oscillator, okay? So once we have recorded in the chart, we will be able to find out that the ROC can be a positive value, a negative value, or it could be zero. So when we show it in a chart, the chart is going to move above the zero line and also below the zero line. So when it goes down below the zero line, it means it is an oversold situation. The securities are available at a very low price. So during that time, we'll make a buy decision. But when the line that we have drawn using the closing prices goes above the zero line, we know it's an overbought situation and it's best to sell the securities at this time because it is now having a good price. You'll be able to sell it at a higher price than what you bought. Now when the line goes from above the zero line to below the zero line, it is showing a trend reversal. It means the price is now going to fall. So it is best for you to sell the securities at this point. And when the line is moving from below the zero line to above the zero line, again it means there's a trend reversal and prices are going to increase. So it's best for you to buy at this point of time. So likewise, the ROC chart is used to calculate or to make a decision on whether to buy the securities or sell the securities. Second type of oscillator is RSI, which stands for Relative Strength Index. In the Relative Strength Index also, 14 days RSI is calculated. To calculate the RSI, we need to calculate the RS first, which is the relative strength, and then apply the formula 100 minus 100 divided by 1 plus RS to calculate the RSI. So let's see how all that is done. See, here we are calculating a 14 days RSI. To calculate the 14 days RSI, we'll take the price of 15 days. Now, then there will be a column for gain and loss. In the first day, there is no gain, there is no loss. In the second day, the price rises to 132. That is from the previous day, there has been a 2 rupees gain. So in the gain column, we'll show 2. On the third day, the price fell down to 130. That is from the previous day, there was a 2 rupees fall in the price. So we're going to show it in the loss column as 2. On the fourth day, the price became 135. That has been a gain of 5 rupees. We are going to show it in the gain column. And likewise, we are going to record all the gain and loss. If the price remains constant, like in the case of the 8th day and the 9th day, the price is 140. So in the 9th day, there is neither any gain nor any loss. So we'll just not record anything in that on that particular day. There's no gain, there's no loss on that particular day. Now, after we have recorded the gain and loss of all these 15 days, we're going to add up the gain column and the loss column. The gain came up to 25 and the loss came up to 10. And then we are going to divide it by the days for which RSI is calculated. Since this is a 14-day RSI, we are going to divide it with 14. Please note that we will be calculating it with 14 and not 15. We have to take 15 days closing prices to calculate 14 days RSI. We'll have to take 17 days closing prices to calculate 16-day RSI. So that is when you're calculating, divide with 14. You will get 1.786 as the average of the gain, and you get 0.714 as the average loss. Now, to calculate the relative strength, you have to divide the average gain by the average loss, and you will get 2.50. So you have calculated the RS value. Now, to calculate the RSI of the 14 days, 100 minus 100 divided by 1 plus the RS, which we calculated, that is 2.50. And you'll get the answer as 71.42. So in case of relative strength, we'll take two values. We'll decide 70 as the upper limit and 30 as the lower limit. We'll take a sell or buy decision when crosses the upper limit or lower limit. So if the price goes above 70, then we should sell the securities because it is available at a high price. If the price falls below 30, then we have to buy the security. It shows a downward trend. I'll explain it once more. I'll make it more clear. See, once the price has gone up to 70, above 70, and then it shows that it is going down, then it's best to sell it at this point, because if it crosses the 70 line, it means it's going to follow a downward trend and the price is going to fall. So the technical analyst will make a sell decision at this point. Suppose the price has gone below the 30 line and then it slowly reached up to 30, then technical analysts will purchase the securities. They will buy the securities because it's going to show a trend reversal and the prices are going to rise after that. So they will make a buy decision at this point. So RSI charts are helpful in such a way. So that is the second oscillator. There is one more oscillator known as a moving average convergence and divergence. In this oscillator, we'll calculate two exponential moving averages. Okay, I hope you remember what is exponential moving average. See, we calculated the factor and applied a formula and calculated the EMA, right? So we are going to calculate two different exponential moving averages under moving average convergence and divergence. A short-term moving average of 12 days and the long-term moving average, exponential moving average of 48 days is the popular combination. The difference between the short-term EMA and the long-term EMA will give you the MACD, which is the moving average convergence and divergence. So MACD is calculated by calculating two exponential moving averages, a short exponential moving average and a long-term exponential moving average. Usually a 12-day and 48-day exponential moving averages are calculated. Then we find the difference between the short-term and long-term exponential moving averages to calculate the MACD. So that is the third oscillator. Now, when we record these MACD, when we are going to plot it in a chart, we'll see that the line will go above the zero line and below the zero line. If it is crossing from above to below, that is, if it's going to cut the zero line and go down, it shows a bearish trend. If it's going to cut the zero line and go above, it is going to show a bullish trend, which means a trend reversal. And the technical analyst will make buy or sell decisions accordingly. So that is with regard to the mathematical indicators. The next type of indicator which a technical analyst use is market indicators. Under market indicators, they are going to consider the breadth of the market, the short interest, the odd lot index, and mutual fund cash ratio. So what do you understand by the term breadth of the market? See, when we analyze the market, we'll be able to see that some of the prices of some securities, the prices of some securities will increase in a particular day, whereas on the same day, the shares prices of other securities will fall down. So we are going to calculate the advances, that's the rise of price, number of securities whose price has increased and the number of securities whose price has fallen during a particular day. These are known as the advances and the declines. We'll find the difference between these advances and declines, and this is called the breadth of the market. Suppose on Monday, the number of shares whose price has increased is 620, and the number of securities whose price has fallen is 350. So we got the advances as 620 and the decline as 350. So what is the difference? The difference is 620 minus 350, advances minus declines, which is a positive 270. That is your breadth of the market. On Tuesday, suppose the number of advances was 470 and the decline was 510. This means more number of securities prices fell than the securities whose prices rised. So we're going to get the difference. Advances minus declines. Advances 470, decline is 510. 470 minus 510 will give you 40, negative 40, because there is more declines than advances. Now, when we are calculating the breadth, we are going to calculate the cumulative breadth. Okay, so previous day the breadth was 270. Today the breadth is minus 40. We are going to add those together to find out the cumulative breadth of the market. That is 270 plus negative 40 will give you 230, and so on. We'll keep on calculating the breadth of the market, and then we'll plot it out in a line graph. We are able to see that normally the breadth and the market index will move in the same direction. But whenever there's a difference in the direction, it shows there's going to be a trend reversal. For instance, if it's a bull market, if the breadth declines, when in the bull market we know that the index will keep on increasing, but in that situation, if the breadth suddenly declines while the market index is having new highs, it shows that the stock price is now going to fall. So it's going to show, it is an indicator of a trend reversal. That breadth may also show a signal of a recovery, that is from a bullish phase it's going to a bearish phase. This is happening when the market index is going down, the breadth line suddenly increases. It moves, it shows a rising trend. Then it shows as a trend reversal, the market is going to change from a bullish phase to a bearish phase. So breadth of the market is calculated by finding the difference between advances and declines. Advance and declines is nothing but the number of shares whose price increased on a particular day and the number of securities whose prices fell during a particular day. We are going to calculate the difference, and these are known as a breadth. Now we'll compare it with the market index. If it's moving in unison with the market index, it means there is no change in the trend. But if it shows a sudden deviation from the market index, it denotes a trend reversal. Now, the second type of market indicator is short interest. Short interest is also known as short selling. Now, there are some speculators who will engage in short selling. In short selling means they do not actually own the securities, but they will enter into a sales agreement. Okay, suppose I am a short seller. I am going to agree with you. I am going to enter into an agreement with you that I will sell 100 shares at rupees 10 each on 5th of next month. Okay, so what I do not have these 100 shares at rupees 10. What I'm expecting is that on the 5th of next month the price is going to fall and I will be able to purchase the securities at rupees 8, and then I will sell it for rupees 10 as entered into agreement, and I'll make a profit of 2 rupees. This is what a speculator is thinking when he engages in short selling. So he is going to enter into an agreement to sell the securities when he doesn't have the securities with him. What he expects is that on the day of sale, on the agreement date, the price is going to fall and he'll be able to buy the securities at a cheaper price and sell it off at a higher price. So what happens is that we'll see the volume of short selling in the market. If there's a large number of people who has engaged in short selling, it means that they will have to purchase the security at some point of time in order to make the sale. So it shows that there will be a demand for that particular security at the future date if there is a large number of short selling. When there is a large number of short selling, they are going to purchase it in the future, and then slowly, because of that activity, the price is going to rise. So the short interest or the short selling volume is taken into consideration before making a buy or sell decision. Under short interest, we will calculate a ratio. A monthly short selling volume is divided by the average daily volume to give a ratio which indicates how many days of trading it would take to cover up the total short sales. So within how many days are these people going to purchase the securities in order to sell it? So that is denoted by this ratio, where they will divide the monthly short selling volume with the average daily volume. And if the ratio is less than 1, it means that the market is going to decline. And if the value is that the ratio that you calculate is 1.5, then it indicates that it is going to follow a bullish phase soon. So the short interest will also give an indication as to the trend in the market. The next one is odd lot index. So there are a lot of small investors who want to purchase securities in small numbers. Usually people will buy it in lots such as 100 shares per lot. But odd lot means they will buy a few number of shares because they are inexperienced. Now what the technical analysts believe that the decision taken by the odd lotters will be wrong. They will always move against the market. That is, when everyone is purchasing the securities, they will enter into a sale agreement. When everyone is entering into a sale agreement, they will enter into a buy agreement. So we'll calculate the odd lot purchases and the odd lot sales to determine the coming trends. To do so, we'll calculate an odd lot index, and this index is calculated by dividing the odd lot purchases by the odd lot sales. An increase in the index will suggest more buying activity, and a decrease in the index will suggest more selling activities. So we'll divide the odd lot purchases by the odd lot sales, and if the index is more, it shows buying activity is coming, and if the index is less, it shows the selling is going on. There's one more indication. When the odd lot index rises noticeably, it means that the market is going to decline. In similar way, when odd lot sales increases greatly, it means that there is going to be a rise in the market or that the prices are going to increase. So these are the two indicators. The odd lot index rises noticeably just before a decline in the market. And similarly, the odd lot sales increase greatly, causing a fall in the odd lot index just before a rise in the market. This is their signal to make a decision. The fourth one is mutual fund cash ratio. See, mutual funds will collect the money from a lot of people and they will invest it in different portfolios, right? Now, they will keep a cash ratio, which is a certain percentage that they keep with them in liquid cash without investments. That is, they will keep it as a safety net. They want to keep some money with them. They're not going to invest 100% of the money that they collected. They will set aside a certain percentage as liquid cash. Now, if the ratio with them is huge, if they have got huge money as liquid cash in their hands, then they are going to look for new prospects of investment. This means that the market is going to improve soon because investments are going to come in. But if the ratio with them is very less, it means they have already invested in various opportunities and there is not much prospects left for investment. So it means that the market is going to fall. So depending upon the cash ratio with mutual funds, the technical analyst will take a particular decision. So these are the mathematical and market indicators of technical analysis. I hope it is clear. Thank you.